Crypto prices reacting to the Fed's decision to keep interest rates unchanged amid the central bank's more than year-long campaign of rate hikes. The Fed is also projecting 2 more rate hikes this year.
As we're in the midst of this rally, yesterday we weren't exactly sure where the market was going to go. Were you surprised yourself in the room when you heard the projections revealed of at least 2 more hikes?
Now, what's happening? Is this really a game of catch-up? Is this kind of a FOMO play that we've been seeing?
Hello and welcome back to my channel. Are you wondering what's going on with the economy right now? How will the Fed's decision affect the liquidity cycle? And how will this affect asset and crypto prices? In today's video, Lyn Alden will share her insights on the current state of the economy and the liquidity crisis, as well as its impact on Bitcoin and other cryptos. To know more details, stay tuned until the end of the video. And if you want to stay up to date with the latest crypto insights, the markets, and the economy, be sure to hit that subscribe button and the bell icon. Okay, you ready? Let's dive right in.
I think in the near term, liquidity conditions are a key driver. So that's something to watch. We'll probably talk about that a little bit more. Basically, dynamics between the Treasury and the Fed, and whether or not cash is being sucked out of bank reserves or not. So I think that's a big variable. Beyond that, kind of longer term, more structurally, the U.S. fiscal deficits are a big variable because they're very large, both in absolute terms and as a percentage of GDP, and that is basically a background inflationary stimulatory force. And of course, it's offset by other things, Fed tightening, trying to restrain the private sector. But you have these kind of 2 really big forces pushing back on each other, which is different than some prior recessions that we've had. And probably another big variable has to be China. Basically, right now, China's, they're reopening, their overall kind of, coming out of their lockdowns has been kind of mild. They've had slow economic growth, and this affects things ranging from commodities to just overall global business conditions because they rival the U.S. in terms of economic size.
Wall Street stocks retreated on Wednesday after the Federal Reserve kept interest rates unchanged. The U.S. Central Bank decided to keep its key interest rate steady for now in the range of 5% to 5.25%. However, forecasts from the policymakers indicated strong support for 2 more smaller hikes by the end of 2023. Lyn Alden suggests that we need to keep an eye on the interplay between the Treasury and the Federal Reserve, as well as the movement of cash in and out of bank reserves. These dynamics can have a profound effect on the overall economic picture. Let's get into the next clip to hear more from Lyn Alden on this matter.
This is something I've been tracking for a while, and for the past 6+ months, it's been a very mild scenario. It's been constructive, and the problem is that now it might turn more rocky. And so basically, the Federal Reserve is, for the most part, removing liquidity from the system. They're doing quantitative tightening. They had to briefly add liquidity to the system after the bank issues in March. So they've kind of been liquidity flat, but in general, they're still doing quantitative tightening. So they're still a net liquidity subtractor. And in the first half of 2022, you also had the Treasury refilling their cash account. So the Treasury has a big cash account with the Fed. And when they fill that up, they're basically pulling liquidity out of the system. And when they draw it down, they're pushing liquidity back into the system. Basically, they want to maintain about $500 billion in their what is essentially a checking account. And part of the reason why the first half of 2022 was so bad for asset prices is because the Fed was no longer doing QE and the Treasury was aggressively filling up its account, and therefore you had a really bad environment for liquidity. In the second, around autumn, you started to see the Treasury cash account draw down because they were overfilled. So they're pushing cash back into the market. And so even though the Fed was doing quantitative tightening, it was being offset by the Treasury. So you went from, really bad liquidity conditions to flat liquidity, which is also when the stock market bottomed and when the dollar index peaked, all in that kind of like late September period last year. And then they ran into the debt ceiling. So instead of just drawing down to their normal cash target, they had to draw down to roughly 0 over several months. And so from that period, kind of the last quarter of last year, all the way up until this debt ceiling resolution in early June, you had the Treasury offsetting the Fed. They're pushing all their cash, literally all of it, into the market, and so you had flat liquidity conditions, which was constructive, at least not terrible for a number of risk assets. Obviously, tech and things like Bitcoin, they did the best. Other areas were kind of more flat in general, but you didn't have that really negative asset period like you had in the first half of 2022.
For the last 6 months, things have been calm and positive, but Lyn Alden fears that there's trouble ahead. The Fed has been tightening liquidity by implementing quantitative measures. They want to reduce the overall liquidity in the system. However, they did have to add a bit of liquidity after some banking issues in March, so it's been a bit of a seesaw, but overall, they're subtracting liquidity. And the Treasury has been doing that too. In the first half of 2022, they were filling up their cash account with the Fed, effectively draining liquidity from the system. Now, here's where things get interesting. The absence of the Fed's quantitative easing, coupled with the Treasury's active cash management, created a challenging environment for liquidity. Then, in fall, the Treasury started spending its cash account, putting money back into the market. This move offset the tightening efforts of the Fed, resulting in a period of flat liquidity. And guess what? That's when the stock market hit its lowest point, and the dollar index reached its peak in late September. But just when we thought we had smooth sailing ahead, the Treasury hit a roadblock: the debt ceiling issue.
Now that the debt ceiling has been resolved, the Treasury is once again going to refill its cash balance. So the Fed's doing quantitative tightening, and the Treasury is going to refill its cash balance. So this is potentially resuming a negative liquidity trend. It's not materialized yet, but it's something that is now on the horizon for later this month and then the months that follow. And the challenging part is to see how that's going to affect markets. So we can't be sure how it's going to affect markets, but what we can kind of be sure of is that it's a more uncertain liquidity scenario going forward than it has been over the past, say, 6 to 9 months. And I think the biggest question is, can they get that liquidity come out of the reverse repos, or is that going to come out of banks? Because if it comes out of banks, that's when we probably have a problem. Liquidity really drives a lot of asset prices, at least for major asset classes. Some stocks and will still do great or do poorly based on their fundamentals. But in general, whether risk assets are doing well or poorly, in large part depends on liquidity. And basically we're kind of going to get a test in the system for how tight can the Fed be when we're getting basically a record deluge of new Treasury issuance, right? So when the Treasury was drawing down, it was easy for the Fed to be tight because they were being offset. But now if they're both being tight, you could get something to break, or they could try to figure out how to get out of reverse repos, but that's harder to do. I think you have to look at a couple of things. One is just general S&P indices. They tend to track liquidity pretty closely, not necessarily on a week-to-week basis, but like on a month-to-month, quarter-to-quarter basis. That's a big factor. It's not the only factor, but it's a big one. Another one you want to look at probably is bond market liquidity, so Treasury market liquidity. During the when the stock market bottomed, and the dollar index peaked last year. If you looked at what was happening in the Treasury market, it was kind of ugly. So not just the yields and the performance of things like TLT, but it was also the liquidity and the volatility. So the MOVE index was extremely high. Liquidity was very poor, right? So there were, auctions were weak. There were tailing auctions, and so, as the Treasury started, drawing down its cash balance, that largely fixed itself. And then the question is, now that we go into another period of Treasury's offsetting liquidity, Fed's offsetting liquidity, you probably want to pay attention to the health of the Treasury market, in addition to just asset prices in general.
Now that the debt ceiling has been resolved, the Treasury is gearing up to refill its cash balance, while the Fed is sticking to its quantitative tightening measures. This suggests a potential return of a negative liquidity trend, although it hasn't shown up just yet. But here's the catch. It's a looming concern that we need to keep an eye on in the months ahead. If you want to keep an eye on liquidity, there are a few things to watch out for. First, you can look at the general S&P indices as they usually move along with liquidity trends. Another thing to check is bond market liquidity, especially Treasury market liquidity. The real challenge lies in deciphering. How will this affect asset prices? It's hard to say, but we should brace for more volatility. The future liquidity scenario is shaping up to be more unpredictable. So, is a weaker economy on the horizon? Are we going to see more crises in the market? Let me know your thoughts in the comment section below. And don't forget to subscribe to my channel for more updates on crypto and the economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and we'll see you next time. Adios.